Well, it's Will's month, and your social media is probably filled with all kinds of promotions for you to get a will and work on your estate planning. So today, in this episode of the Wealth Nation podcast, it's episode 199, we're looking at effective ways to reduce your estate duty liability. So estate duty is one of the many death taxes, as I call them, that you would have to pay or your estate would have to pay when you pass. All right. And these tips that I'm going to give you are going to ensure that your financial legacy intended for your loved ones is maximized and it's protected for your future use. So it's important that in your estate planning exercise to put in, maybe incorporate some of this that I'm talking about in place to reduce your estate duty liability, to ensure that the financial legacy intended for your loved ones is maximized and protected for their future use. So there's numerous ways you can put these mechanisms. If you're following my content, I always tell you that, products are never solutions. It's strategy that drives these products to come to a solution to meet your need. All right. And hopefully I'm going to mention some products. If you don't know how to use them to reduce your estate duty liability, click the link where you're listening to this podcast or where you're watching this video, and I'll be happy to sit with you and do your estate planning with you. So the first thing that you should consider as part of your estate planning, I know it's going to sound crazy, right? But it's investing in a retirement annuity. So a retirement annuity, I know you're thinking, but we're not planning for retirement, we're planning for estate planning. But this is an approved retirement fund. It's regulated by the Pension Funds Act, but it's a very effective vehicle which allows investors to save for retirement using pre-tax money. All right. So when you contribute to your pension, your provident, your RA, this is pre-tax money. This is money that hasn't been taxed. All right. And for that, you will be restricted to when you can access these funds at minimum age 55. Many of the more modern RAs are housed on a unit trust platform that is very flexible, including the ability to select and change various funds, asset allocations, and even the contribution structures where you don't have to be paying every month. As and when you have funds, you can just dump it in this RA. Over and above providing the tax deduction on the contributions, RA investors enjoy further tax benefits with no capital gains tax, no dividend withholding tax, no income tax on the investment growth within the retirement fund. What happens in event of your passing with this RA? The funds that are held in your RA do not form part of your deceased estate and are not included when calculating your estate duty liability or your executive fees. This means that your RA is effectively continues to provide tax benefit even after your passing. In the event of your passing, the funds are held in your RA. It will be distributed to your financial dependents at the discretion of the fund trustees. And this process is expressly provided for in terms of Section 37C of the Pension Funds Act. So while you are permitted to nominate beneficiaries in your RA, if you have RAs, you would have done this already, it is the trustees who will ultimately decide who will get these funds, particularly when it comes to minor children. All right, they take precedence. And also loved ones that are financially dependent on you, for example, parents. While the funds held in your RA, generally speaking, they are protected from creditors, keep in mind that there are a few exceptions. Certain deductions are permissible in respect to arrear contribution and amounts and payable in terms of the Divorce and the Maintenance Act. All right, that's an RA that you're using for your estate planning. The next tool that you want to use to reduce your estate liability is life insurance. In terms of Section 4Q of the Estate Planning Act, all assets that accrue to your surviving spouse, either in terms of your will or in accordance of the law of interstate succession, this is deductible from the gross value of your deceased estate and will therefore be excluded for estate duty purposes. It's a little joke that we have in the industry, Section 4Q, 4Q. But it's a really nice hole or loophole that you can use where you bequeath your life insurance to your spouse, all right? And it's not used in the calculation for estate duty. As such, by nominating your surviving spouse as the beneficiary of your domestic life insurance policy, the proceeds of the policy will be paid directly to your spouse in event of your passing. What happens? It bypasses your deceased estate. No estate duties, no executive fees will be payable on these amounts. That said, life cover can be used effectively in your estate plan to ensure that any estate duty liability can be covered without having to realize any assets intended for your heirs. Meaning that, one way you can use life insurance here to keep your estate duties low is one, bequeath the proceeds to your spouse, and two, you take a special estate cover, right? It's nothing special about it. It's regular life cover. You just leave your estate as beneficiary, right? And this will cover a lot of the costs and a lot of the various debt taxes that we have to pay when we pass. All right, this would mean that, other assets won't have to be sold to recover the funds that are needed to wind up your estate. All right. You have to keep in mind, though, when you do this, when you leave your estate as a beneficiary of one of your covers, this policy will be considered deemed property in your estate and will be included in estate duty calculation, right? So 2 products, 2 different beneficiaries, 2 different taxation rules. So for estate duty purposes, a spouse includes any partner in a marriage or customary union recognized in South Africa. If you are cohabiting with your life partner, you will therefore need to take steps to ensure that your union is viewed as permanent, and this can include signing of affidavits, entering into a cohabitation agreement, providing proof of joint ownership of property, amongst other things. All right, the next tool that you can use is the transfer of growth assets into an inter vivos trust. Now, inter vivos trust can be used effectively to house assets such as fixed property or business interest, so that the growth on those assets takes place within the trust structure and not within your estate, which in turn will have an effect of reducing your estate duty liability. So in order to use the trust optimally for this purpose, you can sell your growth assets, such as your family home, to the trust with a loan account forming part of your estate. So although the loan amount will reflect at the selling price of the asset and not the value of the asset at death. So as an estate planning tool, an inter vivos trust used for these purposes is ideal for preserving assets that are likely to pass from one generation to the next. So if you elect to make use of an inter vivos trust to reduce your estate duty liability, it's important to fully appreciate the consequences of transferring property to the trust. All right, we see the benefits of the trust, but getting to those benefits, there's a lot of hurdles to jump over. So once you've sold an asset to a trust, it becomes property of the trust and is subject to the control of your trustees. As such, it's important to ensure that you choose your trustees carefully and that the trust deed clearly states the mandate of your trustees. All right, and lastly, you gotta consider donations tax. So if you enter into the inter vivos trust, you set this thing up, you can further reduce your estate liability by using your annual donations exemption of 100,000. If you are married, you and your spouse can donate a combined of 200,000 per year without attracting any donations tax, which is levied at a flat rate of 20%. So if you put $1 million into the trust, 20% donations tax, right? While at the same time ensuring that the growth of capital is confined to the trust structure. So although this mechanism, it's really effective in estate planning, it's important to ensure that you do not need the capital to provide for your living expenses, right? The money that you want to put into this trust, it's forever money. You don't need it now. It's specifically for wealth building. Once this capital is donated to the trust, it becomes trust property and subject to control of the trust. All right, so those are just a couple of tools that you can use to keep your estate duty low. If you want specific estate planning, we'll be happy to guide you through that process. And how we go about doing it is sit with you, we understand what you have, what your various assets, explain to you what the liability of those assets are going to be, what really happens to those assets upon your passing, what goes into your estate, what can be passed on directly to a new beneficiary. We'll do the calculations for you and tell you what the whole cost to wind up your estate is going to be, break it down and tell you exactly what fees, from capital gains to estate duty, executive fees, etc. The next level of planning from there is to try and figure out how we're going to fund this this expense of estate duty and the various steps that we can take. And then we'll execute the plan for you. So if you need that, click the link where you're watching this video, listening to this podcast. I would love to chat to you one-on-one.